So with interest rates creeping up again across the mortgages, or swap rates creeping up across the mortgages, is it time for the Bank of England to start to look at cutting its base rate, which of course we've got a meeting this week, or are we going to be stuck on Table Mountain, and is that interest rate going to stay higher for longer? In this video, what I want to do is see where we are in the housing market, have a quick look at where we are in the economy, and sort of have a discussion about that question. Should we be seeing the red flags that are in the economy and looking at getting the base rate down? Or in fact, is everything a lot rosier than people think? There seems to be a lot of positivity in the media at the moment with housing market and economy. And actually, will that mean that interest rates stay higher for longer? Those are the questions I want to look at answering in today's session. So before we do that, I wanted to give an overview on the latest HPIs, both the nationwide and the Halifax, which are now out. We've got both, so I want to do them both in a oneer. We can see that the nationwide came out and showed us a monthly change of 0.4%, which is, acceleration down from last month in March. But the big thing on this, when I look at it, is when we look at the non-seasonally adjusted nominal figure, we've actually had a slight tick up in terms of house prices. So we've gone from £261,142 in March 24 to £261,962 in April 24. So yes, we are showing a negative 0.4% drop in the nationwide HPI, but nominal increase. I saw a lot of news articles come out about this. In fact, if I flip over to the iPad, we can actually see this article came out following the nationwide, where it talked about the housing market turn for the negatives. It was talking about the housing market go down. So what does that mean for buyers and sellers? So seeing a continuation of downtrend, plus when we look at the swap rates, okay, let's just come over and have a look at the swap rates, have a look at the mortgage rates. We've got an increase of fixed rate mortgage rates that have crept up over the last, I would say actually over the course of this year, has put increased pressure on house prices. Actually led to a fair amount of negative press following the nationwide. Then we've got Halifax that comes in, comes in over only a couple of days ago, and we've actually got a 0.1% increase, right? So not a huge amount. Now they were expecting a little bit more, but we can see sort of a break in the trend down from the Halifax. If I can just zoom in on that, so you can see this a little bit better. In fact, it might be better if I go here. Let's face it, it's pretty much flatline, isn't it? But interestingly, it's amazing how the mainstream media just pivots on a sixpence, depending on what pieces of data come out. When we go to the iPad and look at the press, this is what we've got now. We've got Savills have come out talking about house price forecast of 2.5% up in 2024. We've got Sunday Times talking about property market revival on the cards, despite flatlining prices. So look, we've got a lot of conflicting data going on. So I would love to know what your thoughts are where we are right now in the housing market, because it feels like we're kind of a bit of a steady point. We're kind of flatlining a little bit. Everything's a bit stagnant in terms of prices. No major moves either way. And we've got a bit of conflicting data coming through. And I think a lot of people are just sitting on their hands right now as we wait for the next CPI information that comes out. And, of course, the Bank of England base rate. Although, in all honesty, it's probably unlikely that a Bank of England base rate change is going to change mortgage rates, swap rates that much, because any drops the market are betting on this year, and I think the market are betting on a couple of drops this year, are probably already baked into those swap rates, if we're honest. So we're kind of sitting in a bit of stagnation at the moment. But when we dive in more, and if we go and have a look at Halifax, if we go and have a look at the Zoopla HPI, I thought something was quite interesting is looking at the amount of mortgage approvals that have gone through. This is quite telling, okay? So we can see, again, let me try and zoom into that. So we can see over on the right-hand side here, quite a consistent trending up of mortgage approvals. So since that sort of crash following mini budget in terms of mortgage approvals, which has then been sitting below that long-term trend of, let's say, 65,000 a month, we're now trending back up pretty much to that long-term trend line in terms of mortgage approvals. So that is definitely showing a lot more activity. Okay, so I talked a few months ago about the market thawing, unfreezing, And I stand by that and still see an increase in activity. Now the question is, where is this increase in activity, and who's it affecting most? Because of course, an increase in activity doesn't just mean by default that property prices can start skyrocketing. Okay, just because people are coming back doesn't mean things are going to get pushed up. We still have an affordability issue. So in fact, before we go and have a look at the detail, let's look at affordability, right? And if we look at this green line here, which is our average monthly amount spent on a first-time buyer home, again, we've come down from those peaks following the swap rate spikes, but we've kind of stabilized. So things are still expensive, right? We still have affordability issues, but when we look at the ability to afford a first-time buyer home, it's kind of stagnating, but almost, kind of trending very, very slightly up when we look at it. But last month, a couple of months ago, we saw on the Nationwide, they publish every now and again an affordability index where the affordability is actually improving for people quite a lot in terms of getting a mortgage. That's because wages are going up. So we're seeing more activity. Okay, we're seeing the HPIs potentially showing some rises. And again, sorry, just to flick back to the right move, if we go to the price and activity trends, we see a continuation on right move for listing price. Again, take this with a pinch of salt. Right move is definitely listing price. So a bit of a flawed data set, because there's a very strong argument to say that average listing price going up does not correlate to house price sales, but listing, and it could be, again, more expensive homes being listed because people's mortgages are becoming more unaffordable. We are seeing a trend of those average asking prices going up. And when you have a look at it like this, it's a very distinct trend. So everything is trending up right now. So let's see how is this going to affect the property market. Nationwide's actually published some interesting research here. Okay, as to, let me just hit the download ones. The main reason that people are delaying purchasing of the first home. Now, please bear in mind, this is first home. So this is obviously some sort of survey that's gone out to first-time buyers. And we've got the vast majority is citing that house prices are too high, which I think is interesting because the affordability has come down or improved dramatically over the last 12 months. But the next one, or the next couple of mortgage costs are now higher and cannot afford the extra costs involved in buying. So, these higher interest rates are still going to put this downward pressure on the property market. Yes, we've got an article over here on the iPad with Savills talking about 2.5% growth. Whether it's 0, 1, 2, -1, we're not going anywhere quickly, right? And I don't believe these interest rates are going anywhere quickly, because with this positivity, and I talk about it quite a lot, is that cyclical sort of dynamic of confidence and perception. So as soon as the perception starts going up again of house prices going up, house becoming more valuable, people feel they've got more income. Maybe the affordability starts easing, and it doesn't mean that it is easing, but we as humans habituize situations. We've now been in this cost of living crisis for, dare I say it, a couple of years. People have become very sort of, it's been normalized, and therefore any good news, even if it's like less crap news, if that makes sense, is taken with increased confidence or perception. People go out, they've got increased wages in terms of nominal wages. At the moment, yes, we do have real wages. Does that increase perception? Does that increase people buying? Okay. And therefore, could that lead and feed into more inflationary? Now, this is the issue that the bank, or this is the narrative that the bank are thinking about. They're looking at the data and they're going, right, wage growth is still up there. Even though it's trending down significantly, it's still up there. Inflation is still above target, right? Some people are calling for it to hit target, hit 2% in the next release, which is, I believe, next week. I almost can guarantee that's not going to happen, but we'll see what happens. Okay, so even though all these things are trending in the right direction, there's going to be that narrative of, do we have that secondary inflation? We've seen it in the States. We've seen the inflation stick. I know it's a different economy to here, but that increased perception, that increased confidence, will that feed back into inflationary pressures again? And therefore, will the bank want to keep the interest rates up higher? And if they do sit up where they are at the moment, okay, and again, let's just go back to here. Okay, I think this is going to start shallowing the variations. I think we're going to start seeing something more stable. We've obviously seen with the sort of swap rates spike up, come back down. It's coming back up again. I imagine we will see some sort of stabilization, normalization, at this higher rate. I could be totally wrong, by the way. We could suddenly start coming down with the interest rates very quickly, because there are more people in terms of sort of the economist side of things talking about the red warning flags in the economy. And actually, is all this confidence misplaced? Is all this perception wrong? Are the warning signs there? The cracks are showing, and actually we need to get the interest down, the interest rates down quicker, and that the bank is delaying. So, quite frankly, we're at a point where I feel we're probably going to stay higher for longer. I think the market is thinking we're staying higher for longer. If we look at the 10-year gilt, we can actually see that. Let me go down to 6 months. The market were it was going up. We hit almost 4.5 actually not too long ago, sort of end of April. It's coming back down again. So if anything, the markets are now thinking we are going to go a little bit quicker than maybe we thought a week ago, 2 weeks ago. But we're kind of still, I would say, meandering around, this sort of 4% plus or minus 4%. So we're not going anywhere particularly quickly. So I feel we'll get some sort of period of, maybe stability really with the mortgage interest rates, which again, let's just feed that back into house prices, means I can't see them going anywhere very quickly. I've said probably since sort of November last year, we'd probably see a spike up, not a spike up, but a trend up in house prices with effectively swap rates coming down as they did over December. Of course, there's some very good mortgage interest rates in January on offer, and the ability to lock in those fixed rate deals, which are probably a significantly cheaper sort of rates. If we look at here, in January we were all the way down at, for a 5-year fix at 6% loan to value, 4.1% I think is the lowest on that. That's now up at 4.5%, so 0.4% up from where we were. That changes. That does make a big difference in terms of what people can afford. So, final thing to talk about is we've still got a very obvious split, I would say, north and south. Where can I demonstrate that? Well, Zupa are talking about the high mortgage rates hit the Southern England hardest. If we go to the Rightmove and look at regional trends, actually, Rightmove are looking asking prices particularly sort of bullish right now. When we look down the south, we've got Southwest 2.5% monthly change, Southeast 1.8%, London 1.4%, Wales 2.6%, and then actually it tapers off as we go up north. Scotland is higher. I can't help but think, right, that is more expensive properties down south coming on the market as more people are now thinking about offloading those more expensive properties as they come out of the end of their fixed prices. So going forward, look, let's see what happens with inflation this week. Let's see what happens with the Bank of England. I suspect we'll be at 5.25%. I think we'll be up here for longer than we think, but I could prove to be wrong. Whether we need to go down or not is another matter. I think we've got to be careful. We don't want to see the housing market heat up again, because that will not lead to interest rates coming down, right? That'll lead to interest rates coming up. I think we need to see continuation of that healthy correction in terms of property prices. Clearly, when you look at the surveys, a lot of people are still thinking property is too expensive. So actually, a healthy correction down, would be sensible, would be healthy. I think for the market, I don't think this sort of artificially staying high with this data is particularly helpful. And what are people going to do, right? If people can't afford, people still want to buy because rents are so expensive. So people are looking at moving to less expensive areas. They're looking at taking smaller properties, property that needs work doing, flats, fewer bedrooms. So for me, that means much more price inflation, probably in cheaper areas, and smaller properties is what we're going to see, with the larger, higher, more bedroom, larger properties down south probably struggling more. So we're probably going to see that split north-south continue, I would say. So that's where we are. That's a quick update of where we are with the market right now. For the first time, I think we've gone through something and haven't got a single comment. So I don't know if the comments are working or not. Maybe because I'm just going live spuriously because I had a quick gap in the diary and wanted to get out and give a little update, because I know I'm pretty busy right now and not doing a lot of lives. It's amazing when you're actually really busy in the business, you don't get time to go live very often. So if anybody's got any comments, put them in the comments on the replay. I'll always get back to you and answer them. Look, let's go live after the next Bank of England meeting and after the next CPI. The CPI is probably going to be the interesting one, and we'll break down the figures with that. So I'll see you after that one. Hopefully that was a good quick run through. Oh, by the way, of course, I'm so out of practice with this. Look, if you get value from this, and as we break down the figures, when we get some more interesting, I feel like we're in a bit of a holding pattern at the moment until something happens. That creates it. That makes it a little bit more difficult to come up with some interesting, controversial, groundbreaking content when we're in this holding pattern. Everybody's just sitting here waiting for something. Agent, appreciate to see you. I assume that's Agent Smith. Good to see you, comrade. Very nice to have you on. So yeah, apologies. There's not a huge amount going on right now. This Table Mountain is a challenge for content creation. We need something to happen. What I'm going to do is next time I go live, I want to do a bit of a discussion, walk through commercial property. In fact, why don't I just do that very quickly? Let me give you a quick flavour of what I want to talk about with commercial property, because I found this super. I was talking about this right with my property unicorn club summit. Sorry, property unicorn summit that I held last month in London. I was doing an overview of the market, and something that stood out to me was this graphic that I found, which is about returns in commercial property following a recession. Now, technically, we are still in recession, okay, but we're probably going to come out of it, in Q1 of this year. And you can see here, right, that our returns following recession for commercial property spike up. So this is kind of looking at the cycle, 5-year rolling returns. This is looking at the cycle. Now, the reason behind this is when we're in this sort of tougher market, interest rates are high, we're in recession, commercial property is disproportionately affected. It's because of how we do commercial valuation methodology. And I haven't done a sort of commercial valuation methodology talk through for a long time. So I probably will do it on the next live to go through the theory behind how it works. But just assume right now, right, that as interest rates go up, commercial valuations come down because they are directly related to the yield that investors would expect. And as central bank base rates go up, investors' yield expectation go up. So when an investor may have, expected 5-6% on a commercial property, now the base rate is 5-6%. Investors going to want 10-11% on a commercial property to reflect the additional risk. So a higher yield expectation drives down the property values. Let's just go in simple layman's terms, not going into any theory, right? You want to get a higher return on the same income producing asset, you've got to buy it more cheaply, right? So it disproportionately affects commercial prices. So we're seeing, and if I come on to this, we can see how commercial property has been affected since COVID. And what we saw in the UK, by the way, the UK is the, let me just zoom in on that, is the sort of orange line here, okay? You can see pre-COVID or after COVID, so just after COVID, we saw, sorry, I've taken the date off there. You want to see the date. After COVID, we saw this big spike up in commercial valuations, a lot of pent-up demand, a lot of money going around, a lot of businesses buying stuff, and then it fell off a cliff, right? So in 2022, in fact, I think in H2 2022, commercial property as a generic experienced a 40% drop pretty much in values. So a massive correction. Now, if I don't think I've got the drawing tool on and my pen's not working. For those of you who've been watching me for a while, you'll know that I've been saying that I believe it's been a great time to re-enter, a great entry point into the commercial property world. And to caveat what I mean about commercial property, I'm talking about anything that has a commercial valuation on it. It doesn't have to be a block of flats, doesn't have to be a warehouse. It could be many different property types, right? It could be certain sort of HMOs, serviced accommodation, furnished holiday lets, anything that's got a commercial valuation on it. I started rebuying. First offer went on end of Q1 2023. So you can see there where the commercial, pretty much where the market bottomed out. And since then, we've had several fantastic purchases go through. Block of flats, mixed use, another commercial building we're going to turn into mixed use, and some other things. So I still think we're in a fantastic re-entry point to the commercial market. It feels like in the UK, the commercial market has bottomed out and is now starting to come back on. It won't go up anywhere very quickly until the interest rates start coming down, of course, and the swap rates start coming down. So I think we were in an accumulation phase right now for this style of property investment. So if anybody's interested in this style of property investment, I've got loads of links of things that will be of interest to you in the description of the video. So go and have a look at that, especially go and take the white paper which is a free PDF about how to invest in the current climate. And hopefully next time I go live, I'll have a pre-reg link for my new book that's coming out, Property Unicorns, which is all about how to invest in this sort of style of property to create very high cash flowing property investments and how to add value very quickly. So it's a super interesting time for that element of the market, which I know not a lot of people have got on their radar, because residential is, I saw somebody said, Darren from Suffolk, stagnant yawn fest in the market right now. It is. I feel it is a stagnant yawn fest right now. Not a lot going on. Commercial, totally different, really interesting place to be. And it's really starting to heat up, seeing a lot of competition, a lot of people re-entering, but still some fantastic opportunities and sort of properties out there. So I think we'll spend a bit of time talking about that over the next couple of months. I'd like to do a bit more sort of analysis of commercial, about unicorn investing, and take the channel in that direction, whilst we have a snorefest in residential market. And then at some point, rates will come down, or lots of repossessions will start happening, or something will break and it will go either way. We kind of had that sort of compression, and now we're waiting for something to happen. So it will. Anyway, hope that was good. Thanks for your comments, John. Rally boy, hoping for interest rates drop right back down in 2.5 years. The big thing, as I always say, is where do they end up? Do they end up at 3.5% to 4% range, right? Or do they end up in the sort of 1.5% to 2% range? It's going to have a massive impact on the long-term property market, is where they end up. So I think it's really interesting to see. All right, team, it's been a pleasure as always. I will catch you next time. I think we'll have a little bit of a commercial property chat, and that'll be fun. We'll do some case studies and some examples. Have a great week. The sun's out. Hope you're enjoying it. Speak to you soon.